All right, hello, ladies and gentlemen. My name is Greg Michalowski, and I am with FXDD. I am a chief currency analyst for FXDD, and here's our disclaimer: we're not going to give you any buy and sell or hold recommendations during the seminar here today or webinar. What we are going to do is give you some ways that we look at the market, ways that you can define risk, ways that you can control your risk, ways that you can perhaps profit in the markets by being a little bit more aware, a little bit more astute of certain things that may be going on in the market. I am this guy on the left, my partner Sean Powell. I give him credit. He is my partner in these usually, but he's on vacation this week, so hoping that he's having a good time. I'm having a good time here today, so we're both having good times. But anyway, I am the chief currency analyst, and Sean is our national trainer, and we miss him. We'll look forward to him coming back next time. But today, I'm going to talk a little bit about using trend lines in your foreign exchange trading, and oftentimes this is one of those easier things that traders tend to overlook. And I find retail traders don't take trend lines very seriously, and that is a little bit of risk. But what type of risk are you taking? And if you focus on taking the least amount of risk, you have the chance the most confident risk, and that's going to move hopefully toward making the most amount of money. Now, how are you going to do that? Well, that gets into our trader's game plan, and our trader's game plan is twofold, just like the mission statement is. And the trader's game plan to make the most amount of money is the way you do that is by trading the trends. Trends are fast. Trends are directional. Trends tend to move in high-low trading ranges or low-high trading ranges that are much greater than what you normally see in the market. So this is why you make the most amount of money trading trends, and that's why you should focus on trend line or on trading the trends, because you're going to make the most amount of money. And also, the second part of our game plan in trading is this: to keep fear to a minimum. Keep fear to a minimum. If you have too much fear in your trading, you're not going to trade well. Think of anything that you have fear at. Think of playing that game of golf. If you have fear of water, you're going to hit it in the water. If you have fear of the woods, you're going to hit it in the woods. Fear of a sand trap or getting out of a sand trap, you're going to keep it in the sand trap. The same goes for a lot of other games. If you have this inner fear, you're not going to typically do well. And if you have fear in other things in life, at your work, at job, whatever you do, then you're typically not going to perform at your best as well. So you have to, as a trader, you have to figure out ways to trade the trends, but at the same time, keep fear to a minimum. And trend lines help in doing that. So before we get into that, let's talk obviously about trend lines. And this may seem so trivial to a lot of you, but it's important to get through the basics, the foundation, to build that foundation for proper trading. Trend lines connect lows to higher lows. If you have a low, connect a line from a low to a higher low, you have what is called an upward sloping trend line. They also connect highs to lower highs. So if you have on the top, you have a price coming down, you have a high and a lower high, you connect a line to those two highs, and that's a downward sloping trend line. Trend lines also connect lows to highs and highs to lows, and these are what I call remembered lines. And you may not know what a remembered line is just yet, but we're going to go through what I call a remembered line. This is a way that you can remember what a remembered line is. A remembered line is an important type of trend line that I've defined. You will not read about it in most books about foreign exchange until you get to read my book on foreign exchange, which Ed, I will tell people about my book, of course. But it's outlined in the book, and it's also, we're going to outline it here today. And then there's this other thing called channels that use lines. And in a channel, you actually connect a low to a lower low, and you connect a high to a higher high when you're drawing a channel, and that's a form of a trend line. And so we're going to go through channels as well. And I'm always constantly drawing channels within the foreign exchange market because they're very visual. So the rules for trend lines are this: if the current price is greater than a trend line, then the bias is bullish. And so why is that important? A trend line is unambiguous. A trend line tells you whether you should be long or short. If the price goes above the trend line, you should think about getting long. If the price goes below a trend line, you should think about going short. And again, what I mentioned earlier, trends are very visual. Trends everyone can see. We all put up our charts. We all can see and draw the trend lines. It does take a little effort, but you can see and draw a trend line. You should always constantly look to draw these trend lines. And if you do, if you could see it, and it's very plain to you, guess what Joe down the street who trades foreign exchange is looking at? Guess what Mary in France is looking at? Or Maria in Spain, or this trader in Tokyo, or the guy in Australia, or Rain, or London, or wherever or Denver, or New York, or wherever is trading. He can probably see the trend line as well. So you have to pay attention to these lines. If the price is above, that guy's going to think, oh, I got to be long. If the price goes below, then the bias is bearish. That's the second part of this thing. If the current price is less than the trend line, the bias is obviously bearish. So let's just take a look at an upward sloping trend line. This is a dollar versus yen, or dollar versus yen. It's euro versus US dollar. 1, 2, 3, 4, 5 different times the market has tested this trend line. And guess what? At 138.59, where the current trend line comes in on the daily chart, is that level going to be important in your trading? I think so. I think John and Mary and Joe and Jose and whatever all see this trend line coming across up in the euro versus US dollar. So that level is going to be a level of significance. I know we're at 139.33 right now at the moment. This is actually picture was taken obviously earlier, but what I know is at 138.59, if the market gets down to 138.59, there's going to be two possible things can happen. Either we're going to have a number 6 here, and the market's going to move away from that trend line, or we may break that trend line, and guess what? We should be heading to the downside. So the significance of a trend, knowing that is step one. And traders are who know that trend line are going to have an advantage over those traders who don't think trend lines are important, or would rather think of something a little bit more sophisticated to follow, or maybe looking at some other tool that may say that they should buy the market, when in fact this is the most important line that any trader could look at if the market is going to break through that line on that day when the market does eventually break this trend line. And it does. It will break the trend line at some point or another, whether it's after it goes to 145 or it's today when the market breaks through 138.59. I don't know. But all I know is I'm prepared of that trend line. So in this chart here, what people notice is that the market did break through that trend line, and you're probably wondering, well, Greg, what makes you so smart? The market did already break through this trend line after 4 tests of that trend line, and guess what that got me? That got me nothing. I didn't make any money on that trade. Well, guess what? That's trading. Guess what? The trend line still told you to be short when the market broke through the line. The market went lower, and when the market broke back above the lines, what did it tell you to do? It told you to get back long, to square that position, to get out of that trade, to break even on that trade, maybe even lose a little. It didn't do what the market said it should do, and so don't sit there and ignore it. It's an important tool that tells you, hey, get in the trade, and it also tells you to get out of the trade as well. So pay attention to these trend lines and follow them, and you can see that the market moved higher after the market failed below that level. It often leads to further momentum in the opposite direction. So you use these trend lines, especially when they're firmly entrenched, as a tool to anticipate a move or anticipate a move in the other direction. That's what makes them so important. Next time the market came down to the level just yesterday, the market found support buyers against this level, defined the risk, and started to move higher. So anyway, we're going to get into a little more detail here. Looking at these trend lines in a little bit. Downward sloping trend line. This is the dollar versus Swiss. 1, 2, another failure here. This is another instance where the market broke to the upside. This triggered a buy order here. We got some follow through, but guess what we ran into? We ran into this high for the month of December. Market couldn't get through that high, came back down, test trend line, moved back down below, and moved lower. So again, you can take clues from trend lines for looking for a move in the direction of the break or looking for the failure. It goes either way. So why are trend lines an essential tool for your trading? We've gone through a number of different reasons, but I'm going to list some of them here. Trend lines define trends. And what is our game plan? To trade the trends and keep our fear to a minimum. So check off the tool of a trend line as important for our game plan. Trend lines define trends. What else do they do? They define risk. They define risk. And what's our mission statement? To make the most amount of money with the least amount of risk. In our two examples that I've shown so far, what have we seen? We've seen the price move above a trend line or above or below a trend line, and they defined the risk. So if you would have sold that euro when the market broke through that trend line, guess what you've been doing if the market broke back above the trend line? You'd be buying your position back. Did that define your risk? Yes. Is that a good thing? You bet it is. If you don't define your risk, folks, you're not going to be very successful in your trading. You have to define risk. If you don't define risk, you're going to lose. So make sure that you define risk. Trend lines define risk. They keep a fear to a minimum. So if you are able to define your risk, if you know what your risk is going into a trade, and it doesn't have to be a lot when you trade near these near things like trend lines. If you can know your risk and you can define it, guess what that can do to your fear? You have to tell your mind, this is my risk. Can I accept it? If you can accept that risk, then what you do in your mind is diffuse your fear. It's like taking a cup of oil and pouring it into the ocean. It's not going to pollute the ocean. It's just going to be diffused out. Yes, there's a little fear. Yes, there's oil that went into the ocean, but it's going to be absorbed by all the mass of the ocean that's there. It's not going to kill any fish. Now if everyone in the world did it, that wouldn't be good. But if you yourself, you're are the only person that does that, it is not going to have an effect. So that same thing with trading. If you can define your risk, you can accept that risk, you can diffuse your fear, disperse your fear, and that's an important thing because our game plan is to trade trends and keep our fear to a minimum. Fear is a trader's worst enemy. You got to steer clear of fear. Trend lines also are a way, can be used to anticipate a trend. If the market breaks through a trend line, guess what? It may trend the other way. If the market holds a trend line, guess what? It may continue the trend in the upside. And if you can anticipate a trend, are you in better position to trade that trend? Yes, you are. It's the same way. I like to make the analogy between a baseball player. If you're a baseball player and you hit the game-winning home run, the reporters are going to come up to you and say, what were you thinking when you were up there at the plate and you hit that game-winning home run? Oh, I was thinking that the pitcher would throw me a fastball, and he did, and I hit it out of the park. If the pitcher would have thrown him a curveball, he probably wouldn't have hit it out of the park, but he was anticipating a fastball. He got the fastball, and he hit the ball out of the park. Same goes true for businesses. Apple anticipates what users are going to use in their iPad, so they anticipate the demand for applications, for how to use the user interface for their iPad. Everything that goes into that thing that you hold, that's a huge success, that called an iPad, was Apple anticipating what you want. And they are very good at anticipating what the user wants. They are the standard for everyone else. Apple does something, everyone follows. They anticipate, and their most successful traders have to anticipate as well. If you can anticipate a trend, you have a better chance to trade the trends. And what are trends? What's our game plan? To trade the trends. Why? Because trends are fast. Trends are directional. This goes around in a circle, folks. The same story over and over again. Reinforce it. This will improve your trading. They are also helpful in trying to make the most amount of money. If you can trade trends, you're going to make the most amount of money, and that's our game plan. That's actually our mission statement. That was a mistake. The mission statement is to make the most amount of money with the least amount of risk. And so all these things go into the use of trend lines. Now, there is a special trend line that I call a remembered price. And a remembered price is a price level, an actual price level, or it's also an area that the market tends to, guess what, remember. And I know defining something with the word like remember price, defining it by saying the market remembers is really not the best way to do it. So we are going to look at some examples here. But think of it, as a price that the market remembers. The price does not trade a lot, or tends not to trade a lot of volume at that level. It becomes a point of deflection or reflection, and it is represented by a horizontal line. A horizontal line is a line that goes from left to right across the screen, for those people who don't know. As such, it has no slope. So the trend line in this case has no slope, and so it can be used to anticipate a trend as well. Why can it be used to anticipate a trend? Because if a line going across a screen going from left to right is a key price in a chart, what does that suggest about the chart? That suggests over a time period. That suggests that the price is going above and below this horizontal line. That also suggests that the market is probably not trending. It may be, but it's typically these remember prices typically come into play when the market is non-trending. And what do we know non-trending markets can usually transition into? If the market is non-trending, the only thing it can do is either continue to non-trend, that is go sideways, or in an up and down, sort of around that horizontal line, or it can start to trend. So if you know a market is non-trending, can you anticipate that perhaps the market is going to trend at some point either to the upside or to the downside? Yes, you can. So this is another way that you can anticipate a fastball out there. And so remember prices are ways that you can anticipate a trend. Remember prices typically start with an extreme, a high or low price. So those are sort of the characteristics of a remembered price. So let's take a look at a chart, and I'll show you what I mean in regard to, this is a euro versus US dollar, and this was taken this morning, I guess, this picture. And there's certain arrows here that I have here in the chart. And what I want to focus on is, a lot of times the market will have a period where the market comes down and tests a level and quickly rejects it. And you can see this rejection at this point right here. You can see the rejection at this point right here. The market came down, moved sharply up, and then stayed above, stayed higher, came down to this level, moved higher. So whenever I see these kind of extremes, I'll put horizontal lines in my chart, and they become levels that I'm going to pay attention to as a trader. They're going to become levels that I'm going to anticipate that maybe the market's going to find support or resistance at. So when the market moves up and it comes back down to this line, and note here that this is a pretty good, pace to the downside. It's a good pace to the downside. And what do you know about markets that move fairly quickly in direction to, in the same direction? They don't go forever, okay? They find some support level. You as a trader are looking for levels to take profit if you're short, and traders who have no position are looking for support levels that they can lean against, that they can buy the market if the market's coming down real quickly because they know it's not going to last forever. So they'll sit there and they'll put a bid in against this, what I call remembered price, and they actually define the remembered line even more strongly here. So this will typically happen, and then what you'll notice is here, so the market goes up, comes back down again, finds support again. Now it's becoming even more important, this line right here. You can see 1, 2, 3 different tests over the day, and so the market moves higher. It can't move, it moves a little bit above this area and then comes back down. And the next time it goes through is where we get the break. We start to move with momentum in the downward direction. We get through this line here. We move through this line right here. We come to test this, what is called the 100-bar moving average. It moves back up, and we find sellers against this old line right here, against this now remembered area. And a lot of times you'll see this pattern where you have a remembered line close to another remembered line right here, and the market will do that. Typically on purpose. It finds buyers early against this level, and then when it breaks through, it'll use this level as a resistance level with a stop at this point. So would you risk this amount on a trade Yeah, most people would. They would do a trade. Even if they broke here and the market came down, retraced up here. This is a good level to sell against. Why? Because you went through this remembered line. You went through this remembered line. This, or at least this low right here, and you can define your risk. And if you can define your risk and be able to disperse your fear, that's good. And so what you need then is the market to continue in the direction of the trend, and it does. It goes to the 100, comes down to the 200. This is a 200-hour moving average. It finds some support and moves back. But notice here, the market fluctuates back and forth. But even on the correction here, off this low, it failed below the 200. Comes racing back to the upside. What does it do? It stops right at that remembered line. I didn't put it in there. That's what the market does. It's looking for levels to sell against. It not only had this line right here, but it also had this moving average at this point. So another key level where traders can define their risk and move the market away from the level. So you can just imagine here, just in this area right here, that this price right at this level, at this remembered line, didn't trade a lot. Over this day and a half of trading here, the price probably traded very, very little. That's a characteristic of a remembered line. The market moved away from the level. And it continues. It'll remember that price going forward. So the market moves down and we get this trend to the downside. All of these are trading opportunities. Some of them are better than others, but the point is we're using these remembered lines as a way to anticipate a move away, a level where either you're going to be right or you're going to be wrong. But if you're wrong, you're going to lose a little, and you may even get a clue of that to go the other way on the trade because the price doesn't trade a lot at that level. So sorry, continuing further. You can see that the market ends up remembering the price at this point, move down, move to the 200. He remembers this price at this point right here, and moves up away from it. It comes down to this level, moves up, and then breaks through the level. Again, not a lot of volume going through at either of these areas here. Market comes up into the area, has some suckers who buy the market there. It sells back down. It moves back above this level. It uses that level as the springboard to the upside. Uses the level as a springboard to the upside. Breaks through. Even over this whole time period, you can imagine that it's probably a very low risk trading, low volume traded price. It's a level that's going to be of significance. Now I have this yellow area at the top here in the trade over the last few days. And this is something I talked about in my webinar yesterday. And someone asked what I thought about the euro versus U.S. dollar, and I was like, hey, you know what? The bias is to the upside. We're above moving averages. We're near the high, so on and so forth. I can't ignore the fact that we're near the high. So if you're short, you're probably trading against a trend. But I said, hey, you know what? We have a high here. 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 And we broke to the high. We failed up that high, and then we had a high here. This is right at the end of the day, going into the new day right here. And I said, as long as the price can remain below the 140.02 level or below this high at 12, you have a chance. You still have a chance. And so the market did drift off to the downside, and we came back up. And where do we come back up to? We came back up to this remembered line, and then the market sold off again, and now we're at, I don't know where we're at, 35 right now, 139.35. So we're back down at this level. So key remembered line. This trend line as well. I draw a trend line into the market. The other thing that you want to look at when you use trend lines is to combine them with other tools that you may have, including moving averages. I use a 200 bar moving average. I use a 100 bar moving average. This is a 200. This is a 100. I will use those levels as support. And you can see here with the trend line and the 100 bar moving average and the 200 bar moving average, we're going to get a point here where the market's going to have a decision to make. And the more things that you can combine, including trend lines and moving averages, the better chance that you have of the market scooting, moving away where you see those stops being hit, and you wonder, what's causing that? Well, it's all these tools coming together. Let's look at another example, and then maybe we'll get into that you may have. And this is the sterling versus U.S. dollar, and this I have a number of different numbers here on the chart just to highlight the importance of some of these trend lines and why they're so important in your trading. Let's look at one. We have highs here. 1, 2 different extreme highs. 1, 2. And the market moves away from that. Is that level important? Yeah, it's important. So we break through at this point right here, and we go to new high. But guess what? We can't extend the high. So what does it do? It fails up here. Again, if a failure of a key level is just as good as the movement through and the extension to the upside. Trading, you're going to be wrong. It's knowing that you're wrong quickly. If you know that you're wrong quickly, you have a better chance of taking advantage of that. So here, the market failed on this break. The market should have gone higher. It did not. Guess what? It can't go higher. It's finding sellers. So we find the sellers, and look at this. This is an hourly chart. It's ceiling. One guy tries to push it up a pip above the line, and then it fails, and that was the final straw that broke the camel's back. The market moved lower. This is your risk. This is your potential reward. Is this risk a lot smaller than this potential reward that happened, an hour later or whatever? Of course it is. You can define your risk and get lucky and have the market move down, and you can make a multiple of the amount of risk that you traded just by following things like these remembered lines. So let's come down to, we know 2 is up here. Now let's extend 2, and the market moves along, does its own little thing. And when the market has this move to the upside, what do? We come back to 1 right here. We find sellers at 1. It retraces a little bit, breaks through 1, and goes up to 2. That's the next target on the top side. Can it get through 2? No. Failure. Boom. Back to the downside. So pay attention to the detail in the charts. They tell you the thing. Now let's go to 3. 3 has a floor here, floor here, floor here, floor here, floor here. Is this telling you something? Yes, it's telling you there's a floor there. Pay attention to it. We go up to the 100-bar moving average, come back down to the floor. Can't get through this level, so it comes back down. What do? We find buyers. Why? Because there's support still here, and the buyers take the market to the upside. You're not going to get all these trades. I want you to just find some of them, okay? Look for them, find them. Market comes back down through there. Guess what? The market comes down to 3 right here, tests the level at the low, rebounds a little bit at this bar right here, and breaks through. And when it breaks through, we get the momentum move to the downside. That is what you want to see. How many times it tests that floor? Number of different times. Break through the level. At this point right here, we have not only the floor, but we have the 200-hour moving average. That's the green line of the chart. Gives you even more confidence that a break is going to lead to lower levels. It does. The market moves down to point number 5. Let's go to number 4 here. This is an old low right here. This is an extreme. You always have to take into consideration these extremes when you find good support and resistance. The market comes down to 4, rebounds back up to our trend line right at our remembered line at this point, and our 200-bar moving average. Does that give you a clue? Yes, it gives you a clue. So when it breaks through here, we create this ceiling right here. That was the old floor right here, and the market then moves off to the downside. Another trading opportunity that you may have in the course of a day. Low risk trading opportunity to find your risk and moves lower. So now we have number 3 and we have number 5, and we can connect a trend line this low to this low right here because we see the market start to consolidate. And, so you start thinking ahead, start to think, well, if the market is going to go higher, where can we go to? So you draw a trend line that connects a low to a low, and you draw a parallel trend line that connects this high. And at this point right here, if I can put a line right here, assume that the market's at this point right here before the market rallies up to the upside. But you see the market starting to rally upside, so now you have to target different levels on the top side. You have the 100 and the 200, and you have this parallel trend line right here. The market loves the Forex market loves parallel trend lines. They love trends, and they love channels, and they will defend these channels along the way, and they will give you very good trading opportunities, especially when the market's trending, to trade the counter trends or even buy the dips on moves down toward the trend line. So they're important for you to draw channel trend lines in your charts. They're just as important as these remembered lines. So the market moves up And we didn't know this, but this line was in here, and you could draw this line right here, and the market went right up to number 5 and held. When it came back down below this line right here, our remembered line of 4, market came down, found some support probably against this high right here, moved back above, had all this resistance area here, and then had another decision of 5. It held that resistance line. It held this remembered line. It held the 100-bar moving average. Is that a good trading opportunity? Yes. Is it your risk defined? Yes, it is. Is your risk low? Yes, it is. So what do? The market moves down, and you get this move to the downside. And now we get to point number 6, and we have another point where the market moves lower and then moves up higher, creates a remembered price. Market moves down. What do? Test the bottom side of number 5 here, find support buyers, moves up through 5 and through point number 6 here, which by the way held this line right here. Any sort of a sharp move to the downside with a corrective move to the upside, think about drawing a remembered line at that point right there. Especially on this V formation, you're going to find some sellers. Market comes down to number 7, which is this low right here. You can see the pattern here, folks. You can see how if you just think about what these levels are, these extremes, and the market, the foreign exchange market likes to remember. It breaks through this number 6, it breaks through the number 5 at the same level, goes up to the 100-bar moving average, uses the 100-bar as resistance, comes back down to number 5, number 6, and then moves off of that level, gets above the 100, moves up to the 200-bar moving average and number 4. It becomes redundant what I'm saying here, but this is a chart that I trade off of, that I look at to find key levels along the way. Notice the market comes down to 6 here, breaks through the level, sends to the downside, comes back above number 7 here, moves to the upside, comes to the 100, moves above, blah, blah, blah. So, again, I can go on and on and on. That is what you have to do. Trend lines are important. Trend lines, whether they're downward sloping, whether they're upward sloping, whether they're horizontal at what I call these remembered lines, are so important for your trading. It'll lead the way. It'll show you key levels. It'll define your risk. It'll allow you to anticipate trends, to trade trends, to get to the point where you're risking a little with the potential to make more than a little, and sometimes even a multiple of that risk, or oftentimes a multiple of that risk. Trend lines are simple, they're easy, they're visual. Don't ignore them. I have a saying, and it's the KISS principle, and most people think the KISS principle is keep it simple to stupid. It's not. It's keep it simple to be successful. You as a trader have the opportunity to visually see a trend line. That's not hard. That's simple. Don't ignore it. Follow it. Take your chances where the risks are in your favor, where you can define your risk, where you can disperse your fear, and if you do, you're going to be more successful in your trading. So if you have any questions, let's put your questions in. I'm being asked about the dollar versus Swiss. Dollar versus Swiss. All right, so here's the dollar versus Swiss. We're in a channel here. We break above the channel. We move higher. We come down. Another important aspect of trend lines, and especially channels, is I'll often keep the trend lines in. All right, and the reason for at least a little bit, okay. The reason is that oftentimes the market will break a trend line, find some other resistance, like this remembered line right here. Draw a line across there, boom, boom. It's no wonder that the market found sellers here, up and there, you come back, find sellers here, the market starts to move down. And at this point right here, we have this remembered line here off these lows. The market failed on the break to the downside, and then it uses old low as a support level, moves higher. Next time it comes down, it comes down. But the other thing of significance is these underside of these trend lines is what I like to call them, and the market will come down and often test the underside of the trend line. Now here it goes through the level, comes back to the next level, but then then when it moves back above the underside of this trend line here, which had 1, 2, 3 different points, 4 different points of test and move through. So it becomes a significant trend line, and then it'll use that underside of the trend line as support. And oftentimes, a trader can trade against this underside of the trend line, especially after a sharp move to the downside, use it as a support level, move to the upside. So don't necessarily delete a trend line too quickly. It could come back and give you another clue in the market, especially after a sharp move where you're expecting potentially a profit-taking opportunity. This is a profit-taking opportunity for someone who's short up here. It also allows the trader to perhaps trade the counter trend to the upside. Gives you an opportunity. Here the market moves higher. Here we come down to support here in the dollar Swiss. Now the question is, okay, what about the dollar Swiss now? Well, we have 1, 2, 3. Yesterday we broke through the level, and today we broke through this trend line. That trend line comes in at 91.4748 level here today. The low for the day came in at 30. So we got, I'm going to zoom in here, we got a move below and a corrective move above. We got a move below. We should have seen the market go lower. Guess what? It's starting to show signs that the market may has some support buyers down here against this trend line. We broke and we did not go. So I'm sorry for those people who sold the dollar Swiss and didn't make any money on that trade. But this may be an opportunity to do even another trade to anticipate that this trend line, this area is going to hold. What's your risk? The market, if the market goes to new lows, it's showing reasons to think that that you have an opportunity to buy. Another, if you want to be more patient with your buy, look at the hourly chart. And if you look at this hourly chart here in the dollar versus Swiss and look at trend lines, we have this top trend line here. I drew a parallel trend line connecting a low to a low to a low to a low. It broke through that level yesterday and then broke back above. Look how we used the underside of the trend. We got back in the channel, used that as support, used it as support, used it as support on this last move to the downside. So you, as a trader, should look for support in this area about the 26.5. That's your stop if the market goes below that line. So we're trying to show levels of support here in the dollar versus Swiss. Depending upon how aggressive you are, you can buy against the 46 level, put your stop below there. Ultimately, however, we have to get through this 25, 26 level on the downside of the hourly chart as well. So it may be a good low risk buying opportunity currently at the moment. And if you want to be more patient, this bottom trend line makes sense to me. Any other currency pairs that you have here? Remember lines. How long do you keep on charts? Is a question I'm getting asked by Boyke. Remember lines. I will. I try not to have too many lines on my chart. Like I set up this daily chart here because in the dollar versus Swiss. But like these trend lines I don't need in there. The remember lines, however, are almost more permanent for me. But occasionally I'll go in and quite frankly, it's sometimes good to delete a remember line and draw it back in down the road. Because you as a trader always have to look back and say, hey, what is the next key level? And you go back in time. So let's say I have this remember line and I delete it and I delete this right here. Well, if the market starts to rally up, I'm as a trader off of this support line, I as a trader am looking for the next target to get through. If you don't look for target, the progression of a trade is an entry. You have a reason to trade, a defined risk, you enter the trade. The next step is to look for the targets. If you can't reach a target, if you can't reach an exit on this bullish highway, you're driving down the road and you need to get through this low right here. If you can't get, and these highs right here, if you can't get through this area right here, guess what? Your car is turned around and going back down. You need to get through this level, through that level, and you start to define where you're going. What is the direction? What are my targets? Okay, we got through this level here. Good. Can we get through that level? Good. The next target is going to be this level right here. Good. Can we get to the trend line? Good. And then maybe we even get up to this point right here, and I took the line out, but I'm going to see that. I'm going to see that's a key level, especially if I'm long, because I'm looking for where is this trend going to end? Where am I going to get out? So you have to. The answer to the question is sometimes I take them out because I don't want too much clutter in my chart. You want to be able to see the trees, the forest, but then you end up putting them back into your chart as you go along. Like these are no good anymore. They don't do any good for me. So I like this line. I like this trend line coming down off the high, the failure here, the failure above the 100-bar moving average, the failure above the trend line. What a great failure up here. Could not get through this level here, and it sold off. It gave you so many clues there. And now if the market bottoms, it starts to move higher. Now you start to look the other way, and you start to put in remembered ones. What is a new book, and when is it released? I'll give a commercial here. If you're interested in my book, you can go to www.attacking currency trends. That's the name of the book. And you can pre-order. This is actually pre-order. I don't have the books yet to send out, but you can copy here. Go to the store. I have two offerings. One is just the book, and that's at kind of the Amazon price, $7. The other one, if you add a $5 donation, I will match that donation to charities. So you give $5, I give $5, and I'll perfectly I'll autograph the book for you. So. That's where you go, attackingcurrencytrends.com. So let's turn that off, get back to our charts here. Now back to our regularly scheduled program. All right. Nice book cover. Thanks. Thanks, Paul Volcker. I like that. I like your name. Paul Volcker was, of course, a Fed chairman way back when. Let's see. Do big traders play trend lines like the way you illustrate in a chart? Yes. The big traders take a trade and they make it. What they're able to do is take a trade they define their risk. They risk 3%. They should. If they don't, then they're just they're not being smart with their money. But most traders use a defined 3% of your equity risk is what they risk on a trade. They look for opportunities that are going to put the odds of success in your favor. Now, they may have other news or information out there that you as a retail trader don't have, will never have, and they also have a lot more zeros in their account balance. And what does that allow them to do? That allows them to take bigger bets in the market, but the bets that they take are still proportional with their equity. All right? Most traders, successful traders, will risk 3% of their equity in account. They just have a lot more zeros, so they can do a lot more size, and they can push the market in the direction that they like to see. They're also looking for, believe me, they put their pants on one leg at a time, just like you, and they have fear, they have anxiety, they want to see trend lines being broken, they want to see trend lines being held, excuse me, and so they will do the same thing. So maybe, you can't say everyone does it, but my feeling is there are thousands and thousands and thousands and thousands of Forex traders out there, and we all are looking at that same chart. We are all looking at this chart in the dollar versus Swiss. Guess what? If it's visual, if you can see the trend line being broken, that comes down from this point to this point, and it's breaking along with the 100-day moving average. Is that a significant break? Yes. What is the next target? This line right here. Did it get through that level? No. Did we come back down to the 100 trend line? Yes. Did we try to hold it? Yes. We tried to hold it. We tried to hold it. No, we couldn't hold it anymore. That is what causes this to happen. I'm sorry. It does. That's what it is. Do I wait for candles to close up against a support, or do you predefine level that you want to open your trade? It depends, to be honest with you. If the market is in a free fall here, or, let's say, just assume that this is any kind of chart. It's not, and assume that the market is in a free fall. The market's going to look, well, actually, this isn't a good example because this is defining the trend line. Assume that the market is, let's see if I can get a good example, I guess. If the market is is coming down hard here, okay? We've moved down hard, we've broken through the low, and this old trend line here is in my sights, and I may even have a bias, okay, that I want to buy a dip, or I just like this support level. I like this action here. I like that. And I just want to buy it. Then why wait? Put your bid in against the level. Put your stop below the level. You understand what your risk is, and you look for the trade. And if you get a bounce, you're okay. So sometimes people, I think, the whole. They're too restrictive as far as what they do. So they'll say, "Well, I want to wait for the bar to close above it and wait for it." Sometimes, you only get one shot. Okay, you only get one shot, and you have to take advantage of that shot. Here's the euro on an hourly chart. Okay, what did the market do? Let's look at so. We had this trend line. I drew I had this in my thing there, my presentation. I didn't even know. But where did we do? We came right down to the trend line. What else do we have here? We have the 100-bar moving average. Is this a good level to buy? Yes. Do you want to wait for the bar to close up here and then you buy it up here? Well, now you're risking this amount on the trade where you could have risked that amount. Okay, and you got great trade location against that level. So it depends. That's what makes trading a little bit more difficult. You just gotta, if the market's just moving slowly along, and maybe you only have one reason to buy, maybe you don't want to do it then. You want to wait. You want to see it. But if the market's kind of moving along pretty good, and it just made a new high in the hour, we have another move to the downside, and we're kind of in a chop session here today. Why not? It's better than anything else out there. I think, it's better risk reward. So, do that. All right. I really appreciate your time here today. We had a great crowd in for the show. I'm going to be on in another couple weeks, and I don't know if this is going to be taped. If it is, send it to your friends. Have other people. If you liked it, spread the word. How about that? And also, if you can buy my book, that would be great. I talk a lot about moving averages. Well, I use three tools: moving averages, trend lines, Fibonacci retracements. I talked a little bit about moving averages today, and mainly trend lines. But my book is going to outline those things. I'm going to give you those clues that allow you to risk a little and make a lot. Thank you very much, everybody. Have a great day. Who's on board next? But anyway, enjoy your day at FX Street. These guys are great. Thanks a lot. Bye bye.